What real estate decision or decisions do you regret the most?
This one's super easy.
Now just finding out that I'm an old fuddy-duddy, all the time. So I don't know.
For anybody watching this, if you're getting into real estate or mortgage or anything, or any sales job, it's a marketing job first. Best real estate advice I ever got.
Everybody, you're kicking it with the Homeboys and the Homeboys podcast. My name is Clint Weatherall, and as always, I'm here with my buddy Scott Adams. Today, we've got a very exciting show. We're talking about real estate and more in particular, the mortgage market with Aaron Gordon. We found Aaron on TikTok. Aaron knows home loans. We really like his content. He's very similar, actually, to Scotty and I. So there's going to be, you're going to think there's an echo in the room today because we share a lot of the same views on real estate and the mortgage industry. And we're just super excited to be talking with him and having him on. I plan to learn a lot. I know Scotty plans to learn a lot. But without further ado, how we doing, Aaron?
Hey, well, thank you guys for having me. I appreciate it. And you know why we have similar views? We're all old men for TikTok. So,
we are.
We're the old guys network.
How did that happen? Like, I still feel hip and cool, but yet I'm now just finding out that I'm an old fuddy-duddy, all the time. So I don't know.
I love how you start some of your videos. You basically start it that way. You're like, from a guy who's had 30 years experience or whatever you say. It's hilarious to me because we're old.
Yeah, I mean, especially for that format, right. I have a lot of followers on Facebook too, way more followers on Facebook, but I have a ton on TikTok, which is surprising. And yeah, we're old for TikTok. It's a young people's format, that's for sure.
Well, if I can recommend anything to anyone watching, is if you want advice, especially on the mortgage industry and some insights that are deeper level than just the mortgage industry, it spreads into real estate and a lot of other areas. He's got a lot of experience and some really wise advice. In some ways, it's not super sexy. He tells it like it is. But I have yet to see a post that he's made that doesn't resonate with most of the people who have experience in the industry. So he's a great person to follow. He's got a big following on Facebook, which doesn't surprise me. There's a lot of sound advice and folks on Facebook looking for solid, normal advice, where TikTok's a little flashier. But it's also no surprise that you're doing well on TikTok. And I've got to give you credit for that because I think what you're doing is very important because Clint and I talk about it a lot, that this next generation, we've failed them with financial literacy and education. And so folks like you who are jumping on there are doing a service.
That to me is one of the most shocking things about our society. I just don't understand why you have to take 3 years of biology in high school, yet we don't have one semester of mandatory financial literacy. I've never understood that, guys.
So true.
And I you're right. I mean, I have a marketing background. I came into mortgage through marketing, and the way that I was successful very early on was I was really excited by learning a business, which I was learning the mortgage business. I came from the marketing world. And as I was learning, I knew nothing. I mean, I literally knew nothing about real estate and mortgage. I know that I bought my own house, and I was very confused when I bought my own house in my 20s. And I taught myself mortgages through the black and yellow book, Mortgages for Dummies. Literally taught myself through that book, right? But so as I was learning the mortgage business, as I was in it, I was really excited by what I was learning, but it was really complicated. And so I just felt like there was an opportunity for me back then, 21 years ago, to take complex real estate subjects and mortgage subjects and break them down to be super easy to understand. And that's how my marketing's been for 21 years. And it translates really well today in social media, which is every day there's complex mortgage news. Look what happened yesterday with inflation. It's complex, right? I mean, you got to be an economics major or somebody who's an economist to understand even reading the news about what happened yesterday, right? And so I think so. For me, there was an opportunity in when I read stuff and I'm excited by reading it, or I'm interested in reading it, and just bringing it down to a level that's easy to understand. That's been my entire goal on social media. And like you said, it resonates because it's always on a minute or under, and it's a complex subject. And generally I make it very easy to understand.
Yeah, you do a great job.
We love your content, and it's like I said, it really speaks to us. And but we kind of dove into the meat and potatoes a little bit. Tell us a little bit more about yourself. We know you're in Vegas. We talked a little bit about that before we jumped on here. But tell us a little bit about yourself.
Yeah, so Vegas is my primary market. I'm licensed in a bunch of other states as well, but Vegas is my primary market. I grew up in Las Vegas, which was that's fairly unusual for most people. My folks moved out there when there was about 70,000 people, and there's a few million today. So it's been explosive growth. So I came out of college. I went to USC, graduated from college, and I wanted to be a sportscaster. And
you got a radio voice. I even said that this morning when we watched a few of your clips. That's interesting.
Yeah, so I kind of have that radio voice, right? And so I wanted to be a sportscaster, and I was on that path. And then it's just like everybody in life, you get knocked off the path that you think you're going to be in when you're in college. And ultimately, I ended up working in marketing. And my brother-in-law got in the mortgage business, and he said, "Aaron, you got to get in the mortgage business." And I said, finance is boring. I hate finance. I want to do something that's exciting every day.
What year was this?
This was probably in the mid 90s.
Okay. So when we started too.
Yeah, so I'm probably about 30 years old, 32 years old or so.
Yeah. That makes sense.
And so, I knew everything, like every 30 something year old. I knew everything. I knew what I was going to do for the rest of my life. And then all of a sudden I get knocked off that path. And so I had a small marketing company, and it sold, and I had nothing to do. And my brother-in-law was in my ear. You got to do mortgage, got to do mortgage, got to do mortgage. And so finally I said, okay, I'll just try it. And jumped in and really because of my marketing background, I did a bunch of loans in my first few months. I never really had, I didn't really have that start that most people had because I understood marketing. So for anybody watching this, if you're getting into real estate or mortgage or anything or any sales job, it's a marketing job first. Right. I mean, that's what you have to understand about it. If you can market yourself, there's that old adage, fake it till you make it. That's the way it works in the real life with the best salespeople. And I literally had to fake it till I made it the first year. And I closed a bunch of loans, not knowing what I was doing. But I had great resources. There were people in my office that knew what they were doing. And I wasn't afraid to say, hey, I'm not sure the answer to that. Let me call you back. Right. And as long as you're willing to say that to people, all people want is the answer. They don't need to right this moment. So
I want to pause you there and just highlight two things you just said that we feel are so important, especially if young folks are watching. The fake it till you make it, but also at the same time, be willing to admit you don't have all the answers and to go find the answers. Yeah. It's okay to fake it till you make it. In fact, we did it. We believe in it. But you have to be willing to also humble yourself and go get the answers, because faking it till you make it, but then having an ego and refusing to go get the answers is a recipe for disaster. So this is the best advice. We give it all of the time about faking it till you make it and being humble enough to go learn the answers and just do it. You just do it. So sorry to interrupt there. I just wanted to highlight it.
And even worse, giving an answer you're unsure of.
Yeah.
You can't do that either. You'll destroy yourself in business in a week. Yeah. So you don't give an answer you're unsure of. Go get the answer. People don't care about having an answer in the moment. They want an answer, period. So if it takes you an hour or 2 hours or 2 days, that's okay. Especially when you first get started. Look, you guys are learning stuff about your business. You've been doing this a long time. I've been doing this a long time. Every day I go to underwriting and ask them questions of things I don't know. So, it's not really fake it till you make it. It's just, you got to build your depth of knowledge. And at first you don't have it. So you got to go ask a bunch of questions, but it doesn't mean the person that you're selling something to expects you to know everything. They just expect you to do a great job for them and get them the right answer when they do ask in a timely manner. So that's what I did. And so then I started marketing immediately. And my marketing strategy was, like I said, was just take complex subjects, make them simple to understand, and market that to real estate agents and consumers. And it worked. And I've been doing it, 20 something years now, worked at a few different companies. I haven't changed companies many times. I worked at Bank of America for about 8 years in the crash. And now I'm in a place called Guild Mortgage. And I've had a really great career in mortgage, and through mortgage, buying real estate, selling real estate, and all that stuff kind of adds together.
So is Guild able to do loans in all 50 states?
Guild is about a 40-something state lender,
Okay.
But I'm licensed in California, Arizona, Nevada, Utah, and Georgia. But we have resources to get loans done anywhere. So if anybody has a loan in some of those states, Arkansas, whatever, still feel free to call me. I can get that done for you.
Okay.
So
we talk a lot about the Great Recession because Scotty and I both had our feet underneath of us well before the Great Recession and the lead up before the Great Recession. I think it's something that we like to talk about because I feel like there's a huge part of our generation, or not our generation, the younger generation, that doesn't realize that it's not just a constant elevator ride. That we were like the last group that kind of lived through a different economic time, and since then it's been a steady increase. And I know we're going to talk about how it's starting to change now, but talk us through like the Great Recession, you being in the mortgage, industry, what it was like, and like what you had to do to get through it, because we can relate because it was definitely different times for us as well.
Yeah, probably the most difficult period of my life, business wise, financially. Saw my income drop about 75%. And it hit me harder than anybody I would think, because number one, I was in Las Vegas, which was ground zero for the mortgage crisis. I mean, given you talk about the adage of giving loans to people who could breathe on a mirror, we were literally doing that in Las Vegas nonstop. And so, and then the old Big Short thing where you had dancers owning 5 houses and stuff. So that was all true stuff. And so, and when it crashed really, really hard. But you know what? What was interesting about that time, and I'm like you guys, I look back on that time a lot to motivate me today, because what happened in that time for me was the news was on us all the time. I mean, the news was worse and worse and worse every single day. And at one point, I remember saying to myself and seeing people quit the business around me, and I had a lot of friends in mortgage and real estate, and they weren't making it, and they're going to foreclosure and short sale and all that stuff. I remember saying to myself, I am not going to let this happen to me. Okay. The world could collapse around me, but I am going to be standing. Okay. And how am I going to do it? I'm going to put earmuffs on to the news. So I'm going to listen to the news a little bit, but I'm going to let it go one ear and out the other. And I'm going to ignore the negativity. And the next thing I'm going to do is I'm going to put my pedal to the metal on marketing. I've never marketed so much in my entire life as I did in 07, towards the end of 07, 08, 09. I was working, 10, 12 hours per day, every day, marketing. People were sick of my marketing, but it was okay. I didn't care if you were sick of my marketing, because I felt in control, right? The old adage, control what you could control. Well, during the Great Recession, I wanted to control what I could control. And the only thing that I could control were my activities, my sales activities, my marketing activities, and my mindset. And so I emerged. And not only did I emerge, those next few years were some of the best years of my life in terms of loan volume, because I had the pedal to the metal when everybody else was retreating, right? So my phone wasn't ringing either, but my pedal was to the metal on marketing. So even though the calls weren't coming in, that whole trust the process. I trusted the process. I felt like pedal to the metal. Someday I'm getting out of this thing. And then one day I woke up, and my phone was blowing up. My email was blowing up. I had to build a bigger team than I ever had in my life. And it was all because of the activities I did in that period of time. And nobody can convince me otherwise. And it's that I stayed in front of people. Like every real estate agent in Las Vegas during that period of time knew who I was. I made sure of it. And so, 30, 40% of them might have left, but the 60% that stayed, they knew who I was. And it's carried over to this day. So, yeah, it was horrible. Got divorced in it, and lost 75% of my income, lost a house too, but pedal to the metal in my business and came out the other side.
You're like the Rocky Balboa of the mortgage industry.
Keep punching. That's right.
That's what it was.
Doesn't matter how hard you hit. It's about how hard you can get hit and keep moving forward.
My story is actually pretty similar to his, through all of that. But that brings me to you said that a lot of the real estate agents exited the market, and mortgage brokers were exiting the market. I watched a clip of yours this morning that was talking about the retreat of real estate agents. I think it was one that you did pretty recently on TikTok. Do you think that you're getting ready to start seeing that in the mortgage market as well?
Yeah, I mean, I think that when things get tough, a lot of people, there's two ways to react to fear. You run into it or you run away from it, right? And so I think there's a lot of people that run away from fear. And I mean, I see it in my own offices right now. A lot of people saying, and you may see these in your offices, people say, well, my phone's not going to ring anyway, so I'm going to go play 18 holes of golf on Wednesday, right? Okay, great. I mean, that's awesome. I'm glad you're going to play golf, but is that really the right reaction into my phone's not ringing, right? And so I think we're going to be in a period of time here right now with, rates are higher. A lot of buyers have gone to the sidelines. They prices already went up in most markets. So the prices were already high. It was okay if a rate was 4, 4.5, or 5, but a rate in the 6 or 6.5 range is just too much for them to handle. So they're going to move to the sidelines. And there's still transactions being done in every city in America. So if you're a real estate agent or a mortgage person, broker, banker, whatever you are, you don't go retreat because there's fewer sales. You go capture what's yours. I remember I had one of my first coaches ever in the business. And I was so young in the business, as I was told you, it was my first year, but I had a coach. And I remember I was in the office and I had the older guys in the office. Everybody's talking about the market sucks. There's no sales, blah, blah, blah. Woe is me. What are we going to do? So I get on my coaching call and I get my coach online. He's like, hey, how you doing? I said, I'm doing good. I said, market's down. Sales are down. Woe is me. I gave him all that. And there was this pause from my coach. And he said, hey, Aaron, how many transactions are going to be done in Las Vegas this month? I said, about 2,500. He goes, what's your goal again? I said, 6. He goes, 2,400 is a hell of a lot more than 6, dude. Go get your 6. Yeah. And I coach to that. I'm a coach and I coach to that all the time. And that's my mindset now. Look, I don't care if there's 20 transactions in my market. I can still go get my 5 or 6 if I want to, right? So don't woe is me. Like I said, earmuffs. Let the news go in one ear, out the other, and go tackle. Go get what's yours.
Yeah, I hate to say it, but recessions have some positive effects on economies. One of which it thins the weak, and people like you who are aggressive and say, okay, the pie may be smaller, but my piece is just going to get bigger. I'm going to hit the gas pedal while everyone else freaks out, is the kind of attitude that creates success. And if that's what's coming, depending on where the market goes, and it's already difficult, I think, for mortgage brokers and realtors, that is great advice, that just because the pie is shrinking out there right now doesn't mean you shouldn't turn up your business. In fact, now is the time to hit the pedal to the metal. We talked about the last few days for Clint and I, since last Thursday being just chaotic and super busy. And it's because we are hitting the pedal, because we see what's coming and we are working hard. We're turning our businesses up while most people are getting scared.
You'll see my TikTok today that I've been releasing. It's about how investors are turning it up, and people buying houses for owner occupied. Yeah, they're retreating, but investors are turning it up because this is a great opportunity for investors. Less buyers, sellers willing to negotiate, rents are high. This is the time, right? And that's the other thing. If you're a real estate person or mortgage person, you can't define your business. You got to get out of this definition of what your business is. Get creative, right? I mean, if you're a real estate agent and you've been working with a bunch of first-time home buyers, now is not their time. You got to go find those investors and present them the deals. And you can't just go try to find an investor. Go look at deals. Go find deals. Go talk to sellers. What's the bottom this seller is willing to take if you brought them an all-cash offer? Then go find the investor, right? Do a little bit more work. And if you're in the mortgage space, market more to investors. What investor products do you have? There's a really great product in the broker world called a debt service coverage ratio loan, where it's a no income documentation loan for investors. Go absorb yourself in that, learn that loan, go market that loan, because right now is the time. If you don't define yourself, if you go focus more on the investment piece of real estate today, the owner occupied piece, is going to be slower. The second home piece is really going to be slow because Fannie and Freddie changed those guidelines back in I think it was April. And so it was already getting slower. Now it's really slower. But the investment piece is on fire, right? Yeah. And it's like what you guys are doing. Building to rent is something I never heard of before 2 years ago, right? That wasn't, who did that? But now it's a very popular thing for developers to do because developers have changed their business to meet the market, right? And we all have to do that. There's a great lesson in that.
And let's be honest, as veterans in this that we are, and students of the economy that I know you are too, interest rates are still at historically very, very low rates.
Yeah.
Very low rates.
Rates are still low historically. The problem is that the majority of buyers are millennials. And like you guys said, they haven't been through this stuff. To them, interest rates are 2% and 3%, right? 6% interest rates way too high.
Yeah.
They just have never seen that. They don't know what a foreclosure looks like. They don't know what a short sale is. They don't even know what depreciation is, right?
We're just hitting more of a normal, rate right now, and they've been desensitized to what rates should be. We never have been at 2%.
Yeah. Like I said, they've never even seen depreciation. They don't even know what depreciation is, right? So they don't even know what a flat market looks like, right? So these are cycles in real estate that occur, and you can't be afraid of them. If you could just go read online about all the wealth created in times like this. I love telling this story about how in 2008, during the mortgage crisis, the world is collapsing around me, especially in Las Vegas. And this guy came to me. And he's like, he goes, I have a bunch of investment properties. I want to buy my 10th investment property, right? Or his 11th investment property. And there's a rule on conventional financing. You can't finance more than 10, but nowadays you can, but different loan programs. But back then, once you got past your 10th finance property, it was next to impossible. And so he came so I just started a conversation with him. I can't do financing for you, but tell me about these properties. When did you get them? He had bought these 10 properties like in a 4-month period in 2008. I remember thinking to myself, man, Clint Scott, I remember thinking to myself, this guy's the dumbest guy in the United States of America. Does he not read the news? Does he not see what's going on around him? He's paying $180,000 for these homes. These things could go down to $80,000 tomorrow. This guy's nuts, right? Well, that guy today, because I'm still friendly with his agent, that guy today has like 35 homes. He hasn't sold any of them. His net worth's like 20-something million bucks. This guy was acquiring properties as fast as he could in 08 and 09 when the world was running the other way.
When there's blood in the streets, buy is what Warren Buffett says. And
it was genius. It took a lot of courage, no doubt.
A lot of courage.
Yeah, a lot of courage.
Mine was more by accident. Me and a bunch of people were flipping homes back in 05, 06, 07, and then when the Great Recession happened, we had to switch our signs out from for sale to for rent, and I wish that I was as smart as that guy because I was left with a handful.
Let's
of
be
homes.
real. We weren't buying heavily in 08, 09. We started buying real heavily in 10. Mm-hmm. So we were still early. But the people who had the courage to buy in 08 and 09. It's almost inhuman to have been able to be that. I don't think people understand. The world was crashing. And so someone who had the foresight to say, I'm going in. Things are bad. At that point was crazy,
Crazy. And you know what I think about today? What I think about today is, and you guys see this all the time, people will like to call people in their life. Am I doing the right thing? Should I do this? Like everybody wants some kind of validation. If you were buying in 08 or 09, you got zero validation. There was nobody in your sphere, I promise you, that was telling you to buy a house. The
experts were telling you you're crazy.
Right. There was nothing you could have found online anywhere that said you should be buying today, unless they were nuts. They would have looked like these cuckoos on like these conspiracy theorists on TikTok.
Right.
That's what it would have looked like, right?
Right.
Like,
yeah, sure.
Yeah, sure. Yeah. You put your money in there, dude, not me.
We learned a lot from going through that ourselves. And the way we analyze properties now, we adopted a lot of the things we learned from that period, which is when we look for long-term holds or we build something that's going to be a long-term hold for us, we don't look at the value. It's not on our spreadsheet anywhere. It's simply, does the cash flow work? Do the cash flow numbers work? The value is almost meaningless now. We learned that from back then.
You guys are going to love my TikTok today because it says exactly that. It says investors, you look at BlackRock and Blackstone and the biggest institutional investors in the world, those guys that are buying, thousands of houses, and then go all the way down to the mom and pop investors, the ones buying a couple houses a year or whatever. They don't care about appreciation. You can't think about it because it's unpredictable. What is predictable is rents versus payment or rents versus cash flow. That's predictable. And so that's why now is the opportunity for investors. Maybe the best opportunity in the last 5 or 6 years for investors, I think, is today because they don't have all this competition that they faced the last couple of years.
It's been hard for quite some time. Me and Scotty have come in second to hedge funds several thousand times, trying to buy things here.
We got pushed out of an entire market here, an entire type of property in our market here, starting in like 14, I think. We started getting pushed out. And we had to change our model to more suburban houses and some other stuff. But those companies, they come in, they buy blindly. First of all, it's other people's money, so they don't have to think about it too much. But they analyze a property based on the returns, don't care about anything else, literally nothing else. And I've heard, so I don't know if you saw the news, but they raised 50 billion recently. So they raised $50 billion. Can't remember if it was Blackstone or BlackRock, one of those two. They raised $50 billion to go buy real estate because they're foreseeing that there's going to be an opportunity. Yeah. And didn't they just pause buying?
What's that?
Didn't BlackRock just pause buying?
They only in some markets, and those markets are only 5% of their buy anyway.
Oh, yeah. Okay.
So it made big news. Yeah. There's only 5% of what they buy. They're still in the hot markets. But here's what they're doing in Vegas, which is pretty interesting. In Vegas, so they have their buy box, like you said. They don't even care, built after this many bedrooms, sales price this or lower. But what they're doing in their buy box, which is really interesting in Las Vegas right now, is so let's say that you're a seller, you have your home for sale and it's $450, which would have met their buy box very easily a year ago. They may come in and offer you $350. They're gonna test your number, and if you say no, they'll just move on. And so that's pretty interesting what they're doing today. So it's almost like they're working against themselves in appreciation, right? If they snap up all these homes for 20, 30% below list, what does that do to the other 1,000 homes they have in the market, right? It's going to bring those values down. But like you just said, it's not even on your spreadsheet. It's not on their spreadsheet. They don't care about appreciation. They care about cash flow. Yeah, and that's it. And so that's why if you're a buyer today, Grant Cardone has talked about this for years. And I have always thought, I don't agree with this, but now I think I agree, which is, maybe today the opportunity isn't in buying your home to live in. Maybe the opportunity today is buying an investment home. You can continue to rent or live with family or whatever, but why should you stop in real estate if there's a real estate opportunity?
We literally have built this whole podcast almost entirely around that idea. So the American dream is being ripped away from millennials in a lot of markets, okay?
Yeah.
And we want people to understand that you don't have to. The American dream can be a little different. You can still buy rental turnkey properties. You don't even have to know anything or do anything. There's teams all over the nation, where housing is affordable. And if you live in California and you're a millennial and you have no hope of the American dream living there, you can contact a turnkey provider all over the United States in markets where you can still own a home and not miss out on that home ownership that built the greatest generation's wealth and the baby boomers' massive wealth, which was owning real estate. It can still be done.
Yeah. And probably multiply if you're in, and because one of the markets that I used to be physically in, but I still have offices, I still have a presence in, is Southern California. And oh my God, if you're a first time buyer in Southern California, it's just not going to happen. I mean, the advice that we give people all the time is, you may have to go move an hour away from your work and drive in, or luckily there's remote work now, but in some cases, but you're not going to be able to buy in San Diego, probably as a first time home buyer. You're not going to be able to buy in LA or San Francisco. It's just too difficult, but you probably have enough money to go buy in a rural area of Arizona or Nevada or Oklahoma or Arkansas or wherever. You may be able to go buy 3 or 4 houses. Right?
We did a podcast not too long ago where people were moving from San Diego to Tijuana.
Yeah. Oh yeah. That happens a lot because the way that the border works now, you can buy global access, global entry. which is $100 every 5 years, and you can just go back and forth between the border really easily. You can go get a beach house in Tijuana for $400,000. Same house is $4 million in San Diego. So there's a lot of people moving to Tijuana. But if I were them, I wouldn't do that.
No,
okay? I don't love that idea.
No.
Right? You may be better off going to Yuma, Arizona, right? I mean, yeah, I know it's a lot longer drive, but
just rent and buy a rental in Cleveland, Ohio, or wherever.
Yeah,
you can still buy into the dream. So
or go buy a vacation rental. I mean, there's a lot of good data.
Right.
I own a couple of vacation rentals. Find a place you like to go. That way, you could go spend a couple weeks there a year for free, and then have somebody else pay your mortgage and build the appreciation. I mean, once again, don't look at the appreciation piece. You don't get caught up on that. But if it happens, it's the gravy of the deal. And over the past few years, it's been amazing gravy. I posted something on one of my posts the other day about. The average homeowner in the United States has $317,000 of equity in their home. The average homeowner in the United States, their loan to value is 42% right now. I mean, so everybody predicting this crash, where's the crash going to come from? Right. If the average person has 300,000 of equity, okay, maybe they'll give back 50 of it. Right? Is that a crash?
Right.
It's not a crash, right?
Yeah. Unless we see significant drop in values at levels bigger than 2008, this won't snowball as much because people don't understand that leading up to 2008, it wasn't an elevator ride up like we've had here. So there's an argument to be made that any recession has a backstop because there's so much equity in properties right now. So there can be arguments that could make it accelerate because there is more equity and people can sell and just keep lowering prices. But I see it as more of a safety net.
I agree with you. In 08, the biggest thing was literally, and you can watch movies on it, was the way that we financed people. We gave people loans, zero down, don't prove your income. As long as you had a decent credit score, 680 or higher, you get a zero down loan. You could be a plumber or you could be a teacher and tell us you made $200,000 a year. As long as your credit score was 700, we believed you.
Oh, I was king of Ninja back then.
Yeah. So no income, no assets. It didn't matter. Yeah. The financing was on fire. And so basically that's what caused all the appreciation, but nobody had equity.
Right.
Because everybody had borrowed at zero down, 5% down. And so today, not enough people talk about the quality of loan post-mortgage crisis. It's difficult to get a mortgage loan. You have to prove the ability to repay. There's nobody in a house today that they got after the Great Recession that they didn't prove that they could afford the monthly payment on their paychecks, their W-2s, their tax returns, whatever. So those people are in their houses there was no guess at their income. The people pre-08, got in the house. We didn't ask you. We didn't care what your income was. As long as you had the credit score, we didn't care so you could go buy $1 million house. So this was a real life example. You could be making $50,000 a year. Go buy $1 million house with 5% down if you could figure out how to get to 50,000. We wouldn't ask you what your income was. We didn't care.
That's crazy.
Yeah, and let's be clear. This wasn't a one-off he's talking about.
No.
That was standard operating procedure. In any city, in any market, anyone who wanted $1 million home could go buy one if they had the 5% down. It was that simple. You could go buy $1 million home, regardless.
As long as you had decent credit. Yeah. Decent credit was all that mattered.
So that filled the market up with houses that were people who weren't qualified to make those payments, and then were subsequently also upside down because nobody put down payments down. So it was a very different market. But
way different, yeah.
But going forward, so how do you feel about the next year? What's your outlook?
I mean, I think that it's all to me. It's all determined by what happens with inflation. So, lower mortgage rates will stimulate buying. People don't really care about the sales price. They care about the monthly payment.
We say that
I'll go buy, if you go tell me the Ferrari is $600 a month, but it's $400,000, I'll go buy a Ferrari at $600 a month, right?
Yeah.
I'll pay it. You want to give me a 100-year loan? I'll take it. Yeah. Right. So people care about monthly payment, and it feels like what people will digest nationally is about $2,500 or so a month max. That's like kind of the average that people will go. Well, right now we're past that because of where the median sales price is and where interest rates are. So we need interest rates to come down. I think that once interest rates come down, housing will start to go up again. What we really need is, so 51% of home buyers are people who own their homes today. What's it going to take for those people to sell and buy? Well, right now, those people are sitting with a rate of 2.5% to 5% because they all refinanced or they bought those houses in the last few years, right? And so as a result, to get them to leave their 2.5% to 5% rate to go buy a house that's more expensive and have a 6% rate, they don't dig it, and 80% of them surveyed said they're not going to do it. Okay. So interest rates drive everything right now. The challenge we all have, as you guys know, is that the Federal Reserve is trying to control inflation. By trying to control inflation, they're raising rates, but they don't have tied to mortgage rates, but they do buy mortgage-backed securities, and they've stopped doing that. And so they're out of the mortgage game right now. And they've already come out and said that they know what's happening in housing. They're okay with what's happening in housing. They'll jump back in when housing, number one, when prices come down a little bit, but once also when they know they have inflation under control. Well, based on the numbers yesterday, it's coming down a tad. However you're looking at it, you could argue with me, whatever. The bottom line is it's not under control yet. Okay. And so what's going to happen the next year, in my opinion, is that ultimately they will get control of the thing. We'll get a little bit of good news here and there. I just think little bits of good news will make mortgage rates come down. So I think that in the next 6 months, you're probably going to see rates stay, closer to 6. But once that kind of breaks and that inflation news starts to get better, or we head into a recession, because rates will come down in a recession. I mean, some people argue we're in the recession now, but officially recession rates will come down. Then I think buyers will come off the sidelines, homeowners will sell. But what will happen to home prices? You guys tell me. When there's more buyers, right? Inventory is not going to increase over these periods of time because too many people, I don't know if you saw in the last couple of weeks, but inventory is down 17% from last year because home sellers aren't going to put their house on the market because they don't want to go buy a house with a 6% interest rate. So now if rates come down and then there's a bunch of new buyers back on the market, but inventory hasn't increased, right? Now we're in the same boat we were just in, which is prices are going to go up again. So I feel like if you're one of these people that are waiting for something to occur, like you're waiting for rates to go down, you're waiting for prices to come down, it's bad. That's a bad idea.
Right. I think we're kind of in some uncharted territory as well here because, you look, previous to, 2010 and, the Great Recession, our home prices here in Indiana, we were dealing under 250 in most cases. You could have a first time home buyer. We had neighborhoods where you can get a brand new 1,800 square foot home for $130. So the difference in rate between 3 and 6, who cares?
Right.
But now we're talking, first time home buyers are getting in at $350,000, $400,000, $500,000, and the difference, in 3% on $500,000. I mean, it's pretty easy math. It's $15,000 a year. Well, what we saw, we saw so $1,500 a month, the difference in payment, roughly. Right. Just doing some quick, numbers. I mean, like you said, Aaron. I mean, heck, everyone's based on payment. That's going to take a lot of people out. We saw a change in the whole concept of a first-time home buyer's house over those low rate periods. Very true. So the first-time home buyer house would have been a 1,400 square foot vinyl wrapped simple house before that. No one has been building those through this period. Right. Because why? Anyone can afford, with low interest rates, $250,000 loan was the same as if they had bought that. So there's a lack of that lower price stuff. And in fact, in my neighborhood, some of the houses, we saw my neighborhood, which was never a first time home buyer type neighborhood, became almost a first time home buyer type neighborhood. Because people's idea of how much of a house a first time home buyer could take down changed.
Yeah, that's a great point that I haven't thought of. I mean, you're 100% right. I mean, like, what's it going to take for developers to go out there today and build a 1,400 square foot product? Yeah. I mean, the costs probably aren't that much higher to build an 1,800 square foot product or 2,000 square foot product. But you were right. That's how we used to get into homes. We used to stair step our way to houses. We'd get in on spend 100, 120 on your first house. Hopefully it appreciates after a few years. sell it in 5 years at 180. Now you're sitting on a grip of cash, go buy something that's 250, 300. But now it's just completely out of whack. And especially because home builders, you got to go back to the mortgage crisis again. Home builders just stopped in '08. Like they like we talked about, nobody was buying houses and nobody was recommended to buy houses. And builders were just like, stop, we're not going to build. And we saw the effects of that over the last 2 years when inventory was such a challenge. It's because they built, 10% or 20% of the amount of homes they normally build over a 10-year period. And so as they try to ramp back up, look, now they're pausing again. And so, the local regulation has become too difficult. Cost of goods, labor, everything's become very difficult on builders. You guys know you're builders, right? So it's become very difficult for developers to be enthusiastic about building product. And so they'll pause at every scare. Right. And so we're going to have to deal with that. And so, there's a huge opportunity for somebody, I think, to go build first time home buyer products. But to do it, you'd have to get through local regulations. You got to get everything in order. And by the time the challenge for builders is by the time you do it, what does the market look like? Because if you guys decided tomorrow to do a 300 home subdivision of entry level homes, when would the first house sell? 3 years from now?
Right.
If you're lucky.
Mm-hmm. Yeah. We actually had a mayor of one of our towns, a suburb, reach out to us last Thursday or Friday because we had been interested in this 53-acre plot and wanted to build kind of first-time home buyer type houses on there. And they turned us away and brought in a nationwide builder. Well, he called us last week and said, they had two nationwide home builders that were interested in building 300,000 to 400,000, which in our market is a little higher end houses and above. And he called us last Thursday and said they're out. They walked. You guys want to come back?
Right.
So it's already we're seeing
those national builders will move like that. Yeah. They'll pump the brakes like that.
And they're pumping the brakes at the same time that Fannie Mae says, and I haven't seen the latest report, but we're 8 million houses short of demand. What's been built and inventory in the nation. So there's a shortage of housing, yet they're stopping building because they're scared.
Right. So when rates come down and all these buyers come back,
right,
what are they going to buy?
Right. There's a shortage, and these builders aren't keeping up with it.
So we're in this catch-20. Yeah, we're in this catch-22. And so for you that are out there that are saying, I'm going to wait till prices come down, I'm going to wait till rates come down. Rates will come down. Okay. But what will the environment look like when rates come down?
We're preaching buy and then refi later if the rates come down. We're preaching that for everyone, not just investors.
People have laughed at me when I said that. I think this is a great time to buy a house because, prices aren't down, but some sellers are down. There's a lot of motivated sellers out there. Like we talked about, if you have $317,000 worth of equity, okay, I may be willing to give you $100,000 back of that. I may be happy with $200,000, right? What's wrong with a $200,000 profit, right? Or $200,000? There's nothing wrong with that, right? So you may find that right seller. So I'm not saying that you should run into the market, but if you are renting today, you're paying a lot of money to rent, and especially if you're facing your lease is up soon. I promise you, your landlord's going to raise that rent, maybe 10, 20%. You should be looking at houses, knowing that, you're going to pay a little higher interest rate, but rates will come down. It could take a year, 2 years, whatever, but rates will come down. Keep your credit up, keep your job, and you'll refinance at that time. In the meantime, you may not find a better opportunity of sellers today that are willing to negotiate. Yeah, the market may not be down, but the seller may be willing to negotiate. So you have your box of what is the perfect house. Be picky. Find the house that checks almost all those boxes. Go to that seller and say, you're asking $360. I'll give you $320.
Yeah, chances are you won't be up against 10 other cash offers like you were 6 months ago. So you literally people couldn't buy a house. They couldn't. So if you were on the sidelines and you gave up, get back into the game now. This is the time to get back in the game.
Well, Scotty and I always have something on the open market, almost at any given time. I was
about to tell this story.
We just cut our prices on, on a few things that that we're offloading. So I mean, there's people out there like us that are cutting their prices.
We bought one to be an Airbnb, and there were some regulations against it that we probably should have known in advance. But whatever, we're in the business, not a big deal. But we discounted that house because we just want to move on.
Just move on.
By how much yesterday?
30,000.
30,000 dropped a price by 30,000. And
that's an excellent tip. I have a vacation rental in Steamboat Springs, and Steamboat Springs has gotten really tough in the last year. They're luckily I feel like I dodged a bullet, but when I didn't think I was going to dodge the bullet, I went to my agent and I said, if this passes and I'm out, I got to sell this house like quick.
Yeah.
And so that's actually a good strategy for people, like you just said, that if they're looking at investment,